Hello and welcome to Money Matters TV. My name is Michael Verrill and I'm the Vice President of Strategic Development with the Sharp Financial Group. We provide a unique process of integrated financial management, combining accounting and tax, business advisory, wealth management, and capital solutions to help owners of private businesses develop a growth plan to maximize business value and then create and develop and execute on a transition plan to provide liquidity for long-term family wealth and future legacy. Thank you for joining us for our continuing discussion on our segment Growth Stories, where we hear from entrepreneurs and advisors who share secrets and advice on what business owners need to know to grow. From time to time, issues involving technology, life sciences, or healthcare companies may be discussed in the show. Those discussions are not and should not be viewed as financial advice. Moreover, since the show is pre-recorded and shown at a later date, some of those discussions may no longer be relevant. You should always seek advice from your financial advisor before entering into any financial transaction. I'm joined today by my co-host, Rija. Rija is a vice president with CBRE, a global real estate consulting firm. Rija has spent more than 15 years providing research and consulting to corporate occupiers of space. Rija also heads up the media and tech practices in Philadelphia, where she provides high-growth companies with real estate strategies to support their business objectives. Rija also serves on the program development and outreach committees for Tech Girls, an organization that helps introduce middle school age girls to careers in technology. Rija, as always, it's great to have you join me on the show. How are you?
I'm great, Mike. Thanks for having me. It's great to be here.
So, Rija, today I was hoping to get some insight into the economics of real estate. Obviously, that's a big driver of our economy.
Sure.
And I was wondering if there's any indicators that you're seeing right now in the marketplace that might give us some insight on where things are going. In particular, I was hoping to talk maybe about any recent transactions that you had with clients. Are they expanding? Are they contracting? Like, what's going on in the marketplace?
Sure. I'd say generally we're still pretty bullish on the economy in general. We do have a lot of our clients are expanding. There's still a real drive to achieve the right kind of talent mix.
Okay.
And so the expansions are occurring. But we do have some industry-specific downsizes and sublease coming up. So that's a little bit of indicative of an economy that's starting to perhaps turn.
Right. Any industries in particular where you're seeing that?
Yeah, we're still seeing a lot of, just based on the M&A activity in the pharmaceutical industries, life sciences to some extent, and then also media companies.
Okay, so
digital
I know
ad,
a lot of M&A in that space
Correct.
as well, so maybe that's driving some of it. So.
Yeah.
Interesting. Okay, well, maybe we have some a little bit more runway here to grow with a good, strong economy that we're experiencing. Yeah, let's keep our fingers crossed. Before we get into our conversation, we have a question from one of our viewers. I'm hoping you can help me with the answer. Robert Nelson from Philadelphia would like to know, what are some of the biggest needs in the commercial real estate market? Now, I'm going to help Robert hone in a little bit on a specific answer here. I'm going to assume that he means the asset classes. The biggest needs are, what are we looking for? Are we looking for office space, retail, industrial? Maybe he means on the development side. Like what products are you seeing that are still kind of expanding and growing? Is it are developers building office, retail, industrial?
Sure, I would say industrial.
Okay.
E-commerce is really driving a lot of industrial development and shortages. Especially as a lot of these online retailers go to the last mile model where they're trying to get closer to their customers.
Sure. Interesting. Okay, well, we'll keep an eye on that. It's always great to hear from our viewers. To submit for a future show, here's how to send your questions to Money Matters TV.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Some of the guests on this very show, and many of the entrepreneurs I talk to, have had some experience with private equity investors. this can be a great opportunity for wealth creation for business owners. We are pleased to hear from an industry veteran today to share some things that private equity investors are looking for, and also things business owners should think about or know before they enter in any kind of relationship with an investor like that, who they're sharing equity in their company with. We are pleased to welcome today TJ Haas, who is the Managing Director of Business Development for Eureka Equity Partners. TJ, Rija and I are happy to welcome you to Money Matters TV and our segment on growth stories. Looking forward to hearing some insight from you and your experience. I know you've been at this quite a long time, and so we're excited about that, to share some very interesting information for our client or our viewers. Before we get started, I was hoping you could give me an overview of Eureka and kind of give us a little bit of background of what your company does.
Sure. Mike, Rija, thank you for having me today. As you mentioned, I'm with a lower middle market private equity firm, Eureka Equity Partners. We're headquartered in Philadelphia, Pennsylvania. We tend to focus on investing in lower middle market businesses. Typically, those businesses are less than $100 million in top line revenue. That's kind of how we define the middle market. General industry sectors that we focus on, and we've had some experience with, would be in the business services, healthcare services, consumer, and specialty manufacturing sectors. We tend to look for businesses that are privately held, owner, entrepreneur, founder, owner operated. Maybe they're multi-generational family businesses that are looking for either an investment partner to help them grow, take their business to the next stage of growth. Maybe there's some liquidity that an aging shareholder is looking for, while the next generation of the ownership group is looking to stay in the business. So we love to partner with those types of companies, those types of owners, and certainly welcome those partnerships as we find them.
That's great. And TJ, you're on the buy side now with Eureka. Can you just tell us a little bit, have you always been in private equity, or what's your background?
So I am not a lifelong private equity professional. I did actually start out after graduating from college, spent some time in the world of operations, specifically in the microbrewing and craft brewing industry on the West Coast. Worked, as many craft breweries have. There were some restaurant operations associated with them. I was involved in those restaurant operations, so not a brewer myself, but certainly helped to run the restaurant.
Maybe in your spare time.
Yeah, I try my best. And so one of the great things about that experience for me was being able to really get involved in all facets of business operations, whether it was financial management to lease negotiation to inventory management, HR, hiring, firing, mentoring challenges, and then clearly just running the operations of the restaurant. And so very valuable to me. But
practical experience.
Very practical, at home
great.
as well as in the business world. But ultimately, I decided that was not going to be the long-term career solution for me, and that's kind of what led me back to business school.
Okay, great. And did you come back east to business school, or did you attend out on the West Coast?
Kind of halfway. I went to business school in the Midwest with the idea that I was going to make my way back from California with a short layover, 2 years in business school, back to the Philadelphia area where I currently live now. I did grow up here, so I had some fond memories. But post-business school, I knew that I wanted to make a bit of a change from where I was in the craft brewing world, and ultimately landed on investment banking as an area that really kind of interested me quite a bit in my coursework during my graduate school years.
That's great.
And you originally, I think you were with Berwyn originally, right? An old Philadelphia family name who had a number of different practices all around finance and things that they did after creating some family wealth on their own.
That's
right?
correct.
And so give us a sense of that. You investment banking, which part of, I know they did some straight sales of successful businesses, but there was also, I think you were involved in the turnaround group.
That's right. So the first role as an associate there within the Berwyn's investment banking group, I actually worked on both sides of the house, both healthy industrial sales as well as distressed M&A and financial restructuring at the time. Ultimately, the Berwyn Financial Group decided to wind down, and I was able to join a group of my peers at the time, and was part of a formation group of a distressed M&A and financial restructuring shop that relocated from downtown Philadelphia out to the western suburbs, a group called SSG Capital Advisors. And SSG, given that time, it was in the early 2000s, it was one of the last downturns in the economy prior to the Great Recession.
Right.
And so from a timing perspective, it made a lot of sense for me to spend some time on the distressed side of the world versus the more healthy M&A sale process.
Sure.
SSG was quite busy over those 7 years or so that I was there.
Companies.
A lot of businesses that needed a lot of help in restructuring, whether they were over leveraged, had too much debt on their balance sheet, or just ran into some management challenges, or customer orders just weren't coming through the way that they normally would. And that was a great experience for a young professional like myself, where I had a lot of interaction with senior level folks at a lot of those clients, helping them through some very difficult situations.
Right.
And so my role in those investment banking engagements was to make sure that the business was able to live another day,
Right.
Sure.
and or protect the creditors' interest in those businesses, and hopefully get them restructured and continue to operate going forward.
Because I would guess a lot of those were the privately held businesses that we talk about here, and those owners, operators, a lot of their family wealth and retirement income and everything was tied up in that business. Was that typically the scenario
That's
you
correct.
came across?
Yeah,
I mean, it's
and
a dire situation for some of those folks.
And as I mentioned earlier, some of those could be multi-generational. There
Right.
could be mom and dad working with son and daughter in the same business.
Yeah.
So, and other extended family could also be at risk. So there was a real need for these types of processes to try to find a successful outcome, whatever it was.
Right.
We kind of took the approach that failure was not an option, and that we needed to figure out a way to have these businesses survive.
Some sort of solution.
Yeah. But the interesting thing about it too is that I did get the opportunity to work with a lot of the C-suite executive folks.
Sure.
And learned a lot of what not to do in these
Right,
these deals
right.
as well. Some
Share
things
some of those for our viewers.
Yes.
I'm sure that it'd be helpful.
War
Yes,
stories.
some of those things.
High-level things that you'd like to pass on.
Yeah.
Absolutely.
Some of those things were avoidable. Others were maybe foreseeable but not avoidable. One of the basic tenements of corporate finance is that you shouldn't finance long-term projects with short-term financing. And more times than not, we would find that there were businesses that were completely over-levered into a difficult position with a declining revenue base, and they didn't have the cash flow to service the debt that they may have financed a building off of a revolving credit facility.
Right.
Usually not the way that you want to go about financing your business if you can help it.
Right.
Yeah.
So those types of things too. We saw that there was a lot of capital that may have been invested into growth of a business with the hopes that new customers would come knocking. And it's you always wind up in that delicate balance of, do you build it and they will come, or do they come and then you build it? And so sometimes you just can't avoid the timing, and the timing just doesn't work.
Right.
And then depending upon when the ebbs and flows of the economy come,
Sure.
that's when you can tend to get caught in a whipsaw.
The cyclical economic timing, I mean, like you said, foreseeable but unavoidable, right?
That's right.
You're in building products and the housing starts drop by 30%. Like,
That's
now
tough.
what?
You're
Now
not,
what?
not a lot of options, and maybe you look globally or something. I
Yeah,
don't know,
and
what do you do?
you hope that it comes down to more than just keeping your fingers crossed that you're making the
Right,
right decisions,
right.
but sometimes the opportunity is just too great to wait.
Yeah.
Yeah.
And unfortunately you just get caught in a difficult spot. So
Yeah.
that was kind of what the investment banking days of my career really taught me a lot about how not to do things, how to be
Yeah.
careful and measured about growth as well.
Yeah. So after you got beat up for 7 years doing that, you made the transition to the buy side. Give us a little background on how you made that transition.
Sure. Was not really looking to make the change at the time, but
Okay.
answered the phone one day, and it was a recruiter on the other end of the line that was working on a placement for a director of acquisitions
Okay.
of a small holding company, again in the Philadelphia area, which was music to my ears, and that I didn't have to relocate my family. But was really interesting work. It was just doing a lot of the same types of transactional work that I was doing
Okay.
during my investment banking days in a lot of the similar industries. But now I was the person with the capital that was actually going to be acquiring these businesses and structuring the deals, negotiating with the lenders to make sure that the capital structure of the business was appropriate for the business. But unlike the investment banking world, when you're on the principal side, you don't just dust your hands once the deal's done and move on to the next thing.
Right.
You now live with it. You now need to make sure that it continues to grow and follows the strategy that you hope it does, and you hope and pray that things go in the direction that they're supposed to go.
Right.
Yeah,
Figure
there's-
into your investment thesis, right?
That's
right.
right.
Yeah, there's equity stake there at that point.
Yeah.
Yeah.
So that's interesting, right? Because you are having conversations about a company from one perspective as the banker, right? Trying to market that company for highest and best value if you can. And then on the buy side, you're trying to pay as little for that asset as possible, right? To hopefully maximize your return. What was that like? Did it give you really good insight on the buy side because you marched that beat of that investment banker drum? How was that?
I would agree wholeheartedly, Mike,
Yeah.
that having some insight as to how an investment banker is going to approach a sale process, I think gave me and the firm a little bit more of an insight as to how we could approach it.
Sure.
Maybe there were some ways we could be a little more creative in our
Okay.
approach. Maybe there were some earn-out dollars versus paying everything all up front. Maybe if there was a valuation gap that needed to be bridged at the very end, maybe there was a consulting arrangement. Maybe a little bit higher than market consulting wage that you could pay to get a few more dollars of value into
Sure.
a selling shareholder's pocket
Right.
to help that transition. So understanding how that works was certainly helpful. I would say that understanding the timing and the surety of close as well was ultimately the most valuable part of a process. The investment bank clearly doesn't get paid or earn their success fee if a transaction doesn't consummate.
Right.
Clearly the business owner doesn't get the result that they're looking
Sure.
for,
Right.
some sort of liquidity in their pocket, and to be able to diversify their portfolio a little
Right.
bit.
Right.
So understanding that maybe it's not a top dollar value, but a surety to close was very reassuring in a lot of those processes.
Yeah, checking that box and just feeling confident that something was there.
That's right.
Yeah.
Yeah.
Might not achieve everything that you're looking for, but something.
That's right.
Yeah.
And the other interesting part was, in whether it was as director of acquisitions or even now in my seat at Eureka, having people that are looking to roll their equity stake into the business as a partner, a minority stakeholder in the transaction going forward, you find that there's this interesting dynamic with them as well. They're looking to max out their valuation when they're selling, but at the same time, they're a seller and a buyer
Right,
in that same transaction. So we always try to make or hope that we can make the case that maybe the valuation of what you retain is going to be worth more, and that at some point upon exit if we're able to grow the business the way that we want to.
Is that normally a preferred scenario where you've got some rollover equity from the selling founder or business owner into the newly owned entity?
We love to partner with existing business owners if and when the case presents itself. We love the fact that there is institutional knowledge that can stay around the table, and certainly if you're listening to this wonderful growth story about where a business is getting ready to go off and grow along this hockey stick, and yet the business owners want to sell 100% because they have no interest in the growth, that doesn't really make a lot of sense in our heads. So to have a shareholder that's looking to retain a stake in the business is very exciting for us, and that there is some interest in what the future holds for that business.
Yeah, interesting.
And they have investment in that future success. It makes sense. What about when you're looking at companies to partner with and to take an equity stake in? What are some of the characteristics that you look for?
I would say that, one, we love to be the first institutional investor in, so a privately held business, whether that's a family-owned business or something that a founder is still operating, and maybe they're wearing some multiple hats on a daily basis. Clearly, the margin profile of the business is something that we look at to make sure that the return on their dollars as it's growing is able to sustain the growth without having to take on additional leverage or require additional investment going forward. I would also say that the complement of the management team, so how much is the entire management team sticking around, or are most of them leaving? Even if the founder or the owner is staying along, if we don't have a lot of other folks that are needed to run the business, that can be a challenge for us as well. Not to say that's a discussion ender by any means. We certainly understand that there are private business owners that are going to wear their CEO hat one day and their CFO hat one day and their VP of sales hat the next day, and they can't wear all three of those hats and still figure out how to put together a growth strategy and really focus on that as well. So we try to take a lot of that pressure off of them, formalize some of the reporting so that we're able to get some good information, so that you can manage through not just data, but turning that data into information so that you can make educated decisions as to where you go and where you should be growing, whether or not customers are profitable or not.
Right.
And looking at maybe the sales team compensation plans and making sure that they're not just compensated on a gross revenue number, but some sort of margin dollars that they're generating as well. So those are some of the things on a high level that we look at.
Yeah, I would say I think there is a misperception out there. Sometimes businesses that we talk to, that owner thinks he's going to sell the private equity and walk away. And we try to have that conversation with them that, the only scenario where that really works is when you've built that management team underneath you that can truly run the business without you.
Right.
I just tell an owner, if you can't take a 4-week vacation from your business and have it and come back to it and it's running the way you want it to be successfully, then you really haven't built a business that you can walk away with, or anybody would exchange top dollar for you to walk away from, right? I mean, that's value at the door if they're an integral part of that business. So.
Yeah, and that is a common misnomer that I come across all the time, speaking with private business owners, is that when they are ready to transact or to, quote, sell their business, a lot of times the perception is it's an all or nothing. It's either I don't sell any of it, or I have to sell 100% of it. Sure. And if I sell 100% of it, I've got to go play golf for 7 days a week. And how could I possibly do that?
I don't even like golf.
And within the private equity space, certainly Eureka, but a lot of other private equity buyers as well. There are all sorts of different iterations of what that structure could look like. Sure. It could be you could sell a controlling stake. You could retain a controlling stake. there are private equity firms that will put in minority dollars and only buy 40% of your business if that's the transaction that you'd prefer. So it really it's very flexible as to what the business owner is looking to achieve in that transaction, and I certainly listen closely and want to help them get to the right decision, whether it's with us or with another firm. Just making sure that they're aware that there are more options than the all or nothing.
If you are going to have a business owner stay with the business, is there a typical time frame? Is it like, minimum 2 years, maximum 5? Do you have a sense of that, or is it just completely circumstantial depending on the situation of the sale?
I would say, one, it is definitely on a case-by-case basis. 2, I would say definitively over a year. More like 2 to 5 years would be wonderful to have them around. There's clearly a lot of information about that business that we want to glean from them, and hopefully they learn a little bit from us as well.
Yeah, that's great. And if they do have that rollover equity, it is beneficial for them to stick around and help drive that growth, right? If they think they're going to be able to do that.
And that's what we love. We love having that co-investor alongside with us that hopefully is going to see a nice movement in their value going forward as well.
Part of my experience recently has been that smaller companies that maybe 5 or 10 years ago private equity wouldn't maybe consider because they weren't big enough are now also attractive to private equity investors because they've bought a platform and they're looking for acquisitions to make as bolt-ons to a larger platform company. Are you guys involved in that at all? Is that a strategy that you consider?
Yeah, I would say that is definitely an active strategy across the entire private equity community, and certainly Eureka, we focus on that as well. I'd say that just given the current deal environment, it's difficult to find large platform investments at reasonable valuations.
Sure.
Right.
So once you have a platform and you understand it and you have a management team that you trust, it's much easier to find add-on acquisitions, and whether that's through you're acquiring a new geography or a new product line or a new customer set, or maybe it's a couple of key managers that you're looking to figure out how to bring in-house. Those are all very valuable types of add-on acquisitions that we look for.
What are a couple key things that you'd recommend to a business owner who's considering some kind of a private equity investment to maybe get some liquidity in their portfolio?
I would say first and foremost, the better your information is, the easier it is to understand where that information is, the better. I would say if you don't have reviewed, compiled, or audited financial statements, I would say maybe take it to the next step along those lines as well, just for, again, surety of close and understanding truly what the underlying business is generating. And then also, I think we touched on earlier, making sure that the management team, if the business owner is looking to exit, that you have the right people to step into the next stage of ownership.
Well, this is great. It's obviously clearly something as business owner you got to take some time to prepare for. So,
yes.
TJ, I really appreciate your time today. This has been great, hopefully educational for our viewers. Rija, thank you very much.
Thank you, Mike.
Thank you, Mike.
The next guest on Money Matters TV is going to be Michael Korwich of Simone Sajak. And as a reminder, you can download the podcast from iTunes and Stitcher, as well as see programs on our YouTube channel, Money Matters, or I think it's money-matterstv.com. Thank you for joining us for Growth Stories.